Hi, everyone. We're getting started. What do you want to talk about today, Paul?
Thanks, Dino. Welcome, everybody. Certainly, markets have been volatile since Christmas, and we wanted to reassure everybody that this is um, quite a normal process that we're going through. Markets and economies have been through these types of episodes many times before, and it's a time for calm, not a time for panic. So what are driving or what has happened in the markets? Well, since Christmas, global share markets, both the US and global share markets ex-US are both down about 19%. The Australian share market is quite resilient. It's only down 7.5%. And a growth portfolio, which is a combination of shares and bonds, is down about 10%. Why is this? Well, firstly, there have been, as a result of COVID, a lot of central bank and government stimulus to keep economies going, and that has led to strong economic growth. But now that is having to be unwound, and what the central banks are doing now is they're having to fight inflationary pressures. And those inflationary pressures have come from supply chain issues as a result of COVID. And then that was exacerbated by energy price pressures and agricultural price pressures due to the Ukraine conflict.
So, Paul, on the inflation,
Yep.
is that the idea that we might have permanently compounding 7% inflation, or do you think that this is maybe a one-off kind of episode?
Look, nothing in the economies or markets is permanent. So this is everything is ever changing. But the point is that some parts of the inflationary pressures are considered to be longer term, and some are considered to be shorter term. So as supply chain bottlenecks free up, some of those pressures will reduce in a short to medium term time frame. There's already reports that are looking at inflation out 2 or 3 quarters, and they're expecting inflation, parts of the inflation components, to come down. Some are expected to be more a longer term. So there are some structural employment issues where wage pressures are expected to rise, and that can become a cycle of wage rises. But again, there are some reasons to think that that might be temporary. One of the reasons that we have high wage growth at the moment is because international travellers, like the movement of workers around the world, has become much reduced. And so as movement of people free up, we may well also get some decreasing pressures on inflation. So look, it's an interesting argument because we have had a long period of low inflation, lower than desired inflation, and part of higher inflation will actually be healthy for the economy. The risk is that some components are higher for longer, and that will mean that interest rate movements are higher and quicker. And the risk is that the combination of those two events lead us into a recession. That's why markets have rolled over at the moment. But they've rolled over by about 20%, and that's actually about the average correction for this type of cycle, an inflation fighting cycle. So to some degree, a lot of the risk is already priced in. Clearly, an average means that some corrections are higher than others, and we're waiting on that balance point at the moment.
And so, Paul, the Reserve Bank increased interest rates, and the likelihood is that it's going to increase one or two times more. What's sort of that going to have as an impact in the Australian economy, and what's going to happen with home loan rates?
One of the interesting things, a lot of commentators go back to the late 80s, early 90s, when we had interest rates at like 18%. We're not going anywhere near there, but and that's because there's a much greater amount of debt, both government and household debt. And so small increases in interest rates actually impact people's cash flow quite a lot. So the expectations are that The cash rate may go up to between 2 and 3%, which means mortgage rates could well go between 3 and 5%. And that is going to be a big impact on people. What that means is they're spending more money on their mortgage payments, which means they've got less money to spend on discretionary spending, food, etc. And so that's how we get a reduction in economic growth. Reduction in economic growth leads to a curbing of inflation. We get back to a new equilibrium, and then we start growing again. So that's how.
Yeah, and I think the interesting thing when we look at the commentary around house prices as well, it's important to note that although most assets can be sold when people panic, the difference with residential housing when you live in the property is that you'll stay in the property for a very long time, even as economic conditions can get worse and worse. And you actually forgo lots of other things in your day-to-day life as opposed to forgoing paying the mortgage because frankly, you have to do that. And so I don't see that there's going to be a huge selling pressure on properties in and around the capital cities where people work, but maybe there's going to be an impact on people that are having to sell one or two of their investment properties because they're the people that increasing interest rate has the most impact on. If you've got 2 or 3 investment properties and interest rates double as they're going to over that period, as you said, Paul, that interest rate doubling and those payments on your investment properties can't be met with going to the movies or not going away on holidays because the number of or the size of payments is quite large.
I think that's right, Dean. And one of the other things that we need to think about is many homeowners have been in their home for a long time. They've either got no debt on it or they've got a lot of equity in it. So like most things in any cycle, it's really only the people at the margin who are influencing the headlines. Pricing falls. Well, pricing's only falling for those people who are buying and selling. Like it only impacts them. If you're just living in your house and the price is going up or down, it's not impacting you. So we have to be aware that these things are happening around the edges. And yes, there will be some distressed sellers. And yes, there will be some price falls. But it's only going to affect a moderately small amount of people.
True. And another interesting thing that we've seen talking about interest rates increasing is that for a very long time, term deposit rates, which is in a lot of our client portfolios, term deposit rates were 0.5 of 1% for any period from 1 month all the way out until 5 years. And so now in response to what the Reserve Bank has done, which is just 0.25 of 1%, the banks are really, really good at forecasting what interest rates are going to be over the cycle. And so there's all this speculation as to where interest rates might end up. But I kind of you use the inspiration, I suppose, from the banks and what they're doing both in term deposit rates and fixed interest rates as kind of an indicator of where they think rates might end up. And so we've seen some rates at the 5-year mark for term deposits above 4%. And so that's another indicator of where the banks might think interest rates might end up. Because banks don't lose money, right, Paul?
Not for very long. No. And look, that's another interesting point is that for retiree portfolios in particular, and retirees are making up a bigger and bigger part of our economy, they will be getting increased interest rates on either the fixed interest, the term deposit, or the bond part of their portfolio. And while equity markets might fall by 20%, the dividend, the cash payout ratio on their managed funds or their shares stays around the same amount. It'll be somewhere between 3 and 5%. And so they're only going to get a smallish reduction in the dividend payment, like a 20% reduction in their dividend from their shares, but they're going to get a multiple times increase on the income on their fixed income. So they may actually feel little pain or even feel like they've got more cash.
Correct. And the inflation is always different for each individual as well, whether they are traveling the world and therefore flights prices have increased. But if you're a retiree living a more simpler life, perhaps inflation hasn't actually crept too much into your world. Potentially food is a key one that we're actually seeing, and petrol. But there's other things that have gone through this inflation spike that you may not buy and use at the moment.
Yeah, and that's another really interesting point, which is humans are very, very adaptable. So people who are on a limited budget, yes, they're going. They might not go on the holiday this year, or they might not buy the new car this year, or they might cut back on their clothes spending this year in order to reallocate their budget around. So this is why nothing is permanent. Everybody is adapting to change all the time, and as people adapt to the change, then the situation, rectifies itself, and we get back to a new normal and we move on again. So in my mind, this is another cycle. It's a quite a normal thing to happen. We've been through it many, many times before. Everybody adapts. We get through the other side, and we continue on as normal. So there's nothing to really panic about in this scenario. And what it is doing is providing an opportunity for people who, for one reason or another, have got some surplus cash that they've been sitting on. We are now looking at bringing forward our regular investment plans to take advantage of the opportunity. That's not to say that we're all putting it all in at one time. Markets could fall further from here, but as one of our clients who's a very experienced investor says, if you're getting 20% discount, you're still getting a 20% discount. If you can get more at a 30% discount, all well and good, but keep buying at a discount.
Yeah, absolutely. Well, that's a really good summary, Paul, to finish on. And so if anyone has any concerns or wants to talk to us about their individual portfolios, please reach out to Paul Stella or myself, and we're happy to have a conversation with you. But any final remarks, Paul, before we finish off?
No. Don't be worried. This is normal. Worry's not going to change the outcome. It'll only change your experience. And if you do have worries, call us and we can talk you through them.
So. Very good. Thanks, everyone. Have a great afternoon. Cheers.
Bye.